Look at the top of the US stock market over the past few years, and you will see a fortress. Four tech giants and their semiconductor suppliers have built a combined market cap of $18 trillion. 42 companies directly linked to generative AI have driven roughly 75% of all S&P 500 returns, profits, and capital spending since ChatGPT's launch. Without them, the US equity market would have lagged behind Europe and Japan. This dominance relies on a massive deployment of capital. Since the end of 2022, these hyperscalers have collectively spent $1.3 trillion on capital expenditures and research. Capital spending by Meta and Alphabet is now crossing 50% of revenue, 5 times the S&P 500 median. Historically, 2025 tech Capex represents a larger share of GDP than the 2000 broadband build-out, the Apollo project, or the interstate highway system. Deploying capital at this scale assumes that AI can continue to grow without hitting physical or economic friction. But the physical world is imposing hard limits. Historically, tech infrastructure was financed through cash flow. Now, the capital structure funding the AI boom is beginning to shift toward the debt markets. Meta's new Hyperion data center in Louisiana is a primary example. To build it, Meta partnered with an investment firm to create a special-purpose vehicle, which borrowed $27 billion. The structure relies on 4-year renewable operating leases and a residual value guarantee. Meta provides a payout floor that declines over 20 years, creating the economic reality of a triple net lease. Because of how this guarantee is structured, rating agencies treat it as a contingent obligation rather than direct debt. This keeps the $27 billion off Meta's balance sheet, preserving their AA credit rating. Oracle is also borrowing heavily to fund a $60 billion cloud computing commitment to OpenAI. Delivering on that single contract will require an estimated 4.5 gigawatts of continuous power. 4.5 gigawatts is the equivalent output of 4 modern nuclear power plants, or 2.25 Hoover dams, dedicated to one corporate commitment. The industry is building debt-fueled financial dependencies, just as utility costs and grid limitations become the dominant operational constraints. Computation is governed by the laws of physics, which define the absolute floor of the data center power crisis. Running millions of these inefficient chips simultaneously is already straining regional U.S. power generation. Because computation cannot violate thermodynamics, it will always require raw energy. Brute-forcing AI scale with current hardware means hitting a wall of grid capacity long before these massive models achieve their projected profitability. Even with infinite power, processing speed faces strict mathematical limits. Amdahl's law calculates maximum speedup when adding resources, splitting workloads into parallel and sequential fractions. If just 1% of a workflow is sequential, theoretical speedup is capped at 100 times, even with an infinite number of processors. In enterprise AI, those sequential fractions appear as data serialization bottlenecks, memory bandwidth limits, and synchronous API calls. Every unparallelizable step throttles the return on hardware investment. Doubling your GPUs does little if memory bandwidth forces those processors to wait in line. The strategy of purchasing exponential compute to solve inference problems yields rapidly diminishing returns, breaking the economic models that rely on linear scaling. These physical and mathematical constraints are now creating economic fallout for enterprise balance sheets. Model training is a finite project with a fixed budget. In contrast, AI inference, running the model in a live workflow, is a continuous, unbounded utility. Inference will account for an estimated 2/3 of all AI compute by 2026. At this scale, even small inefficiencies in how often a model is queried can break an enterprise budget. The most severe risk is autonomous AI agents operating without hard budget guardrails. These agents can trigger recursive loops, calling each other in infinite chains. While API unit costs are falling, enterprise cloud bills are exploding vertically. A single unattended agent caught in a recursive loop can consume thousands of dollars in compute in just a few hours. This liability multiplies across a large organization as employees deploy unsanctioned shadow AI tools that stay invisible to financial operations teams. Hyperscalers have built infrastructure based on a projected demand curve. However, if enterprise budgets cannot support the volume of high-cost inference, that demand curve will inevitably flatten. Cost is only one variable. A new framework of international regulation is making centralized public cloud AI a legal risk. Under the EU AI Act, high-risk systems require strict data lineage logs and mandatory human oversight. Non-compliance carries penalties of up to 7% of global annual turnover. This map illustrates an unresolvable conflict. The U.S. Cloud Act allows federal law enforcement to access data held by American companies, regardless of where the server is located. This can put an organization in simultaneous violation of U.S. law and European sovereignty. Organizations must respond by adopting placement discipline. AI workloads must be categorized by 5 constraints: latency, cost ownership, regulatory geography, execution volume, and the threshold where localized capacity becomes cheaper than public cloud APIs. Routing enterprise data through a public cloud by default creates operational friction. It leaves the organization managing both the variable costs of high-volume inference and the legal complications of data crossing international borders. One Tier 1 North American financial institution recently audited its infrastructure to address these exact pressures. The firm was processing 1.2 million credit decisions per month through a public cloud. Their cloud bills were running 300% over their forecast. The audit also revealed that their architecture allowed U.S. law enforcement access to European customer data, while failing the strict lineage logging required by the EU AI Act. The institution migrated that specific workload off the public cloud and onto an EU-headquartered private on-premise stack. By moving to owned capacity, the cost per decision dropped from 7 cents to less than 3 cents. Latency fell from 340 milliseconds to 22 milliseconds. The winners in the AI era will be the organizations that align their architecture with physical limits, parallel mathematics, and unit-level financial governance. The bank's migration demonstrates how specific, localized optimization can dismantle the financial and legal barriers of the AI era. For hyperscalers, this represents a new class of competition, based on efficiency rather than raw scale.